Hello, welcome to CATEX TV. My name is Frank Fortunato. This is a broadcast from Princeton, New Jersey on Wednesday, October 5th, 2011. Well, interestingly enough, there is some life in the insurance and reinsurance industry about disaggregating big, expensive risks, managing supply chain risks, and contingent business interruption. Big three words, everybody's learned them since the Tokyo earthquake, should be considered separately to standard physical damage. And BI should be a new product in itself. This is according to Munich Re. August Probstel, head of the corporate insurance division unit at Munich Re, said treating contingent business interruption as an appendix to a physical damage BI coverage was not taking into account the level of complexity involved. Mr. Probstel said that Munich Re is now beginning to break it out insofar as pricing the risk and giving an overall quote. Interesting. Now let's move on to the energy sector. We talked a little bit yesterday about Tom Bolt's plans to have syndicates and Lloyd's underwriters break out liability and offshore oil platforms and energy risks separately. Here's some interesting news. The energy insurance industry has been hit with claims of almost $4 billion during the first 9 months of this year. The market looks increasingly as if it's going to post a loss for 2011. This is according to Christopher Monroe on Insurance Day. According to figures taken from the October edition of Lloyd & Partners Energy and Marine newsletter, insured losses emanating from the energy sector so far this year come to $3.94 billion US, an increase of about $1.5 billion compared to the same figure last year. Now, in Insurance Day as well, following that, is this story. An excess and surplus of reinsurance capacity for upstream energy risks means that there will be few dramatic changes from the January 1 renewals next year, despite the energy insurance market being hit again by significant losses. With the large number of CAT losses this year, it could be assumed reinsurance prices across the board would increase, especially as it's the reinsurers in particular that will have been hit hardest by claims from this disaster. The article goes on to say in Insurance Day, this is especially true when considering the high combined ratios many firms reported at the 6-month period, the depleted reserves of some companies, and the expected increase in capital requirements related to the upcoming Solvency II directive, but capacity remains plentiful. Again, according to Lloyd's & Partners, we do not expect any dramatic changes in reinsurance pricing for upstream energy risks. There'll be pressure, of course. However, the bad news for markets is that it's not cheery news for insurers. Many insurers are faced with rising reinsurance costs, further eroding underwriting margins. As such, a number have voiced the need to take more pain in order to flush out the excess capacity and move the rate cycle on. Interesting. Bolt is continuing to talk about breaking out the liability sector of this as a separately priced product. Saudi Arabia has some activity in civil unrest in its eastern region, largely being instigated, according to them, by Iran. There's a huge fire burning in central Nebraska, 40 square miles, about 230 miles southwest of Omaha. It has basically burned to a crisp. The fire department says that it's going to be worse today as temperatures are rising. The earthquake in August in Virginia has effects still lingering in Washington, D.C. The Washington National Cathedral announced yesterday that it's going to need tens of millions of dollars over numerous years to repair damage to the country's second largest church from the earthquake. And if you've been in Washington, D.C. lately, you've seen mountain climbers rappelling off the top of the Washington Monument, the country's most iconic monument on the Mall, where they are checking for cracks caused by the earthquake. The monument is closed to tourists indefinitely. That's the news for today. If we have any breaking news, we'll come back and tell you. Thank you for watching, and we'll see you tomorrow.